You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means we are back once again. It is Education Wednesday, time for a little bit of what we cool kids call Options Bootcamp, or indeed OBC. My name, of course, Mark Longo from the THE, optionsinsider.com, as well as from the network upon which so many of you are mainlining out there these days. Remember, if you like what you hear, you should be listening to the full network. You're really missing out on just, I think, a literal boatload of content out there. So get out there, have some fun, listen to all the good stuff we've got popping off out there on the network. Speaking of popping off, we got Fed popping off as we speak, so things flying hot and heavy out there in the markets. Of course, if you like what you hear, you want to share it with your friends, leave a rating, a comment, a review, whatever your platform lets you do. All of it in aggregate at the end of the day does help new people continue to discover the content out there. And then, of course, if you want to go above and beyond, you want to join the pro out there, then only one place to go, theoptionsinsider.com/pro, the place to go to learn more. Speaking of reviews and ratings, all that fun stuff, this week we have our 5-star listener review coming in from, I guess, Ninja, but he's trying to be cool. Ninja with 2 N's. And Ninja. I like it. Either way, he's very succinct. He's to the point. He says, sub it. All right, I'm down for it. Yes, sub it on your platform of choice. Hopefully, if you're listening to this, you've already subscribed. If not, what are you doing? Get out there, subscribe, listen to the full network. Have a ball. If you want to go above and beyond, join us on the pro. We just had a double pro Q&A day yesterday. Man, it was awesome. So a lot of great stuff coming at you. Got a double header coming at you today as well. So if you're in the pro, you get a double dose of Options Bootcamp coming at you today, just like you did last week. Man, because we like you folks. So you don't have to wait a week for your second episode. It's right here for you in your ear holes right now. As you listen, theoptionsinsider.com/pro, the place to go to learn more. As we go around the horn and see who's joining us out here on the old Options Bootcamp end of year spectacular edition here. First, let's go out to the Southern volatility mecca, at least not quite Austin this time, not going that far south, but no, we're going a little bit closer to home. Let's maybe revise that to the Southern options mecca, aka right outside the real mecca, which is Chicago. We're going to Frankfurt, where we are joined once again by the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to the show, sir.
Hey, Mark, it is great to be back. We've got some great things to talk about today, and I'm looking forward to it.
All right, we do have some great stuff to talk about. And joining us to help us round out our Options Bootcamp year in high style, we've got our old friend making a return appearance on the show, Mr. Matt Amberson, the founder over there at Orats, and now the Auto Father, a.k.a. the creator of the Rogue AI that is stalking the options markets as we speak. Mr. Matt, welcome back to the show. How goes the battle to contain Otto, sir, and keep him from becoming sentient?
Yeah, I didn't know this was such a big show. Now I'm really nervous, Mark. This is a near end of year palooza. So I got to get ready to go here. Otto, what do you think? Yeah, Otto's in agreement. He's ready to go.
I'm scared. Otto is listening. That means we got to get rolling with the show right on into a little bit of the old options drills.
Calling Boots. Time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
All right, everybody, welcome to a little bit of the old options drills. And today's episode, inspired by something we did earlier this year, actually in the summertime. We had an episode back on June 7th. It was episode 240, and it was entitled quite simply, Is it even worth selling options? Or is it even worth selling covered calls anymore? Because a lot of you had written in at the time, vol was eroding. It was heading into the summertime malaise, and everyone was like, I don't know if it's even worth doing. So we kind of had a little bit of a discussion about it on the show then. And our buddy Mr. P, he's always been a big fan of covered calls. He loves them. I think he's told me before off the air, he's never met a covered call he did not want to sell very aggressively. So he is very much on the pro side. And then we've done a lot of shows with Matt over a number of years now. And we've also talked recently, we had him on the show back in September talking about the wheel. And so covered call has come up a lot with him and on this show again as well. I know a lot of his back tests have pointed to maybe a little bit different conclusion, which is the fact that a lot of the best covered calls in terms of performance seem to be at the end of the day when you push the covered call as far out of the money as possible, AKA the entire driver of profit is really the underlying at the end of the day. So why are you even doing the covered call? So this has been a question that has kind of lingered for us. Again, we touched on it a little bit back in June. It's always been our intention to come back to this and have what we call here the great covered call debate. The one episode to end the debate once and for all. The one episode to rule them all here. Took us a little longer to get to it than we liked. A lot of stuff going on this year. Go figure. We got deep into the wheel, which is, again, covered call related. But now we're back at it. We're going to do it today, listeners. The great covered call debate. We're going to decide this topic once and for all. Is it even worth selling covered calls anymore? And you know what? It's a good thing it actually took us a little while to get to this because volatility has done naught but erode over the better part of the last 6 months. When we were talking back in June, vol had already come off, but it was still in the mid to high teens around a 15 handle. We broke a 12 handle just this past, got into an 11 handle recently. So vol has continued to come off, continued to erode, which again raises this question, the specter of, is it even worth selling covered calls anymore? So let's go out to our guest. We'll give him pride of place to kick off the great debate. If you want to get into any personal slander or slurs as well, Mr. Matt, have at it. The floor is yours, sir. But a lot of our listeners want to know, these days, is it even worth selling covered calls? Is it even worth doing this anymore?
So to answer that question, we do, as we're wont to do over at ORATS, a bunch of back tests. And now we even have the ability to test in certain environments. So we could back test over the entire 2007 to present, and we could back test whenever the volatility was low. We have ways to define low. We could define it by an IV 1 year percentage into thirds. So we would say under 33%. We could look at the VIX just in general, and we call low under 15. So it's been about a third under 15, a third in moderate, 15 to 20, and a third above 20 of the time. So that's how we look at that. So on the first question, I'm going to look at SPY today, just the short call portion of it. And if you look at what are the best performing, there are some actual ones that perform, that have some return to them. It's not very much. I mean, you're adding 0.25% at best. So, I mean, that's really quite poor, right? So, and that's way out of the money. Obviously, since 2000, 7, SPY's been on a tear, so short calls are going to look bad. But so back testing, does not look good for this particular strategy. You got to go out 111 days to get an average annual return of 0.25%. And you're probably going to cut into that SPY. That SPY return, just to give you an idea of what 111 days, what that 5 delta looks like, because that's how far out you need to go. You're getting about 70 cents, and you're going out, for example, you're probably going out, I want to say 15%, 12 to 15% out of the money. So, I guess, that's kind of the average return. So you're going out quite a bit, but you're not going to get that much. So, so just know that that's kind of where you would want to be if you're going to be selling these. And on the other question, when the VIX is low, how does this particular strategy do? So I could just set it to VIX below 15, and then you get, even worse results. Then you have to go out 300 days to the 2 delta is the best one, and you're only getting just barely above break even. So
2 delta.
Yeah, I know. And so, it's just not good. Nothing's going to back test in that. Now I should say we have we've done the wheel strategy. I know I might be getting ahead of myself. So we've back tested the wheel strategy, but I'm going to leave that hanging for now. I'm gonna leave that as my kind of answer. Well, and I said SPY, and we also looked at like Citicorp. That's kind of been up and down and up and down. It hasn't really rallied as much, and still those don't even look that great. Similar. I would say kind of similar returns. TLT again are all negative. So so on the cover call back test, they don't look that good. Mark, how's that for a start?
Uh-oh. Shots fired over here, Mr. Dan. It is now time for you, Mr. Dan, to take the ball and run with it for all of the covered call proponents out there. And if you want a little extra fuel to the fire, you should have heard some of the stuff Matt was saying about you before I brought you in on the show earlier. It was not for public consumption, sir. I think he was questioning your parentage, your lean, all kinds of things were going on out here. So I expect this to be a very fiery retort. But that said, you heard the numbers for yourselves in a decent vol environment. You're talking 5 delta, 111 days, and in the vol environment we're in right now, I can't even say it with a straight face, 2 delta and 300 days, at which point, why are you even selling that call? So Mr. Dan, all of the covered call proponents are now turning to you to defend them, sir. Why should they be doing this nonsense, sir?
Well, I think you might have oversold the Dan as a proponent universally of covered calls here. I am a proponent, but
never met a covered call you didn't like, I think are my exact words.
Yeah, those were the words. That you might be overselling a little bit there. But I am a fan of covered calls, but like with any other trade, it's always got to be very selective. And there's got to be certain criteria. One thing that I definitely have never met is a trade that always works universally all the time. So that is definitely something I never met. But I do like covered calls under the right circumstances, when we have some other things that we can layer on top of, just looking at it completely general from a backtest standpoint, when we can kind of pick our spots where there's resistance and where there is overpriced volatility, which is a nuance that I don't know if Matt did backtests on this. I think what I heard you say, Matt, is that you looked at 3 different tranches of where basically the implied volatility of spiders are. But when we start taking that relative to historical volatility and, really picking our spots with these things, I don't know, man. I think that they can be really, really powerful. And they're not without their without their drawbacks and their shortcomings. When we're in a period like we've been in for the past 6 weeks or whatever it's been, where the market's just violently gone straight up, this covered call has been a little challenging to trade. So I'm kind of, I don't know. I definitely wouldn't call it firing back in that regard, but I do feel strongly, just from personal experience, that when you pay attention to some nuances that are not factored into the option pricing model, not factored into just a pure universal backtest, that they can be pretty powerful and they can add some value to your portfolio.
Now, obviously, I was having a little fun at the top of the show when I said Dan never met a covered call. Most of the covered calls he likes to do out there. But that said, Dan, I know a lot of your systems tend to bake in around earnings. So is it fair to say for you then that it's primarily these single names where you're looking to sell the covered call premium and not what Matt was alluding to earlier with the 111 day and the 300 day 2 and 5 delta calls in SPY? You're not a big index covered call writer, but more of a single name guy?
No, I mean, a little of both for sure. I definitely have done a lot of covered calls on spiders in my IRA. And, I mean, sometimes I'll try and avoid earnings in single names, but sometimes when I'm doing it as a wheel strategy type scenario, I will ride them through earnings, but I'll try and go out a little bit further out of the money. And I guess when I say wheel strategy, I think I might mean something different than most people mean when they say wheel strategy. And so based on what Matt was saying earlier, he kind of deferred talking about the wheel strategy until the next iteration of our conversation. So I'll drop mine. I'll kick the ball to you there, Matt, and we can jump in and talk about what we both think about this idea of what a lot of people call the wheel.
Really quickly before we get to the wheel, because I had to have some thoughts on the wheel. But Mr. Matt, just to tie up a little more on the covered call, and specifically, Mr. Matt, you were talking about indexes. You also mentioned Citi and some single names and looked at some names where it hasn't been the most effective, shall we say. Were there any points in your back test, any specific moments or use cases or even names where you saw and said, you know what, actually, the covered call worked out pretty well on these? Any leap to mind for you, sir?
Sorry about that. I'm holding some cards close to my vest about the wheel strategy, because there are some interesting ways that you could play it with the wheel strategy. But I mean, for the most part, though, it's pretty universal that there's no systematic way really to run a covered call strategy. But I agree with what Dan's saying. There are probably some times if you're looking at maybe technicals, and if a stock gets overstretched, I could, we do have an RSI I could check out, but in general, especially for a lot of these stocks that have moved a good deal, it hasn't worked out. Now, I would say one thing. The skew in SPY has gotten a lot flatter. And I think that's because of the zero DTE phenomenon. And if you want me to explain that, I will. But and that's going to be actually better for call selling strategies, because basically what you used to see is a very steep skew where the puts were high and the calls were low, and now it's because everyone was doing covered calls and buying puts to protect their downside. And it was such a systematic thing for market makers that they really had to jack the ball. I think with the zero DTE, it gives them a lot more chance to get more puts and sell more calls at a flatter skew, which zero DTE tends to give them. And that's kind of made it so it's going to be better going forward for call sellers. So that I will give you that, Mark.
It's funny you mentioned that, because that just came up on one of our pro Q&A sessions yesterday, which again is another reason why you should be listening to the pro Q&As. Listen, a lot of great topics on there, but we were looking at some of the skew in the E-mini yesterday, just offhand, and we both kind of came to the same realization, the guest and I, that, wow, these puts are nowhere near as bid as they usually are, and the calls, you're right, nowhere near as offered as they usually are. So maybe we need to revisit this again in another 6 months. I thought this was going to be the definitive one, but now, once again, Matt, 0 day, throwing a wrench into everything out there. But that definitely is a phenomenon we had noticed. I wasn't sure if it was just seasonality at work or there was something else at play, but it is definitely something we noticed. So in that sense, listeners, the covered calls you're overriding, even though vol is low, if skew is managing to remain a little bit more resilient, it could offset some of that a little bit, which is interesting. So Matt, is it fair to say, before we get into the wheel, which I want to get to too, is it fair to say your viewpoint on this is there's really no good systematic way to implement covered calls across, let's say, even a broad index portfolio like Aspire, SPX? It really is more of a pick your poison type of thing. You have to do it opportunistically. And if you try to do it systematically, you get back to what we were talking about, the 300-day 2 delta type calls.
Yeah, I mean, that's the only systematic way that's shown profitability in a back test. But again, if you're nimble and you think you have, you have the stock and you don't mind selling it at a certain spot, I mean, that's a different computation. But I'm saying from a back test point of view. But I would agree with that statement. By the way, I don't know if we're talking about live markets, but the markets just jumped up from about to up 75 basis points, about 0.75% here. The Fed is saying party like it's 1999, basically.
Yeah, the Fed's saying 3 rate cuts next year sometime, hold rates steady today. So yeah, vol popping. I did put on a nice little VIX strangle right before the announcement. So as I am wont to do, I definitely dumped the calls while we were talking, because I've said many times on Vol Views, you have short amount of time to get the calls, usually in VIX land, and today was not the day for VIX calls, so those went the way of the dodo. We'll ride the puts now and see how those work. But yes, looks like for the bulls at least, getting a little bit of the old checkered flag waved to them, saying, hey, let's go, let's cross the finish line here. You guys both want to get to the wheel. I shall not hold you back any longer. The wheel, of course, a very popular strategy. It seems it's almost inescapable on this show these days. All conversations come back to the wheel. We touched on it. I've lost track of how many times in the second half of the year here. So obviously a very popular strategy. But of course, one of the main elements of the wheel is the covered call. So if the covered call ain't worth doing, then what are we doing with the wheel? Dan, I gave Matt the last word on the covered call, so I'll be charitable. I will give you the first word on the wheel, since you both have so much to say on the wheel. So what are your thoughts on the covered call and how it maybe impacts your thoughts about the wheel?
Yeah. So I've had a bit of an epiphany over the last maybe year or so with, I guess what you'd call the wheel strategy and the covered call strategy. And the wheel strategy, I think a lot of people would define as, hey, I own stock, I sell a covered call. If I skate, I sell another call. If I get assigned, then I sell a put. And if I skate, sell another put. If I get assigned, then I sell a covered call against a new stock at. And that's fine. That's the traditional way of doing it. And there's been a lot talked about on that. But what I have sort of layered on top of that, and I've done a lot of work on this. In fact, I updated our covered call class to reflect what I call the cycle recycle trade. And it would be interesting if a back test is even possible on this. I don't really know. But here's what I discovered. It's not really about the premium you collect when you sell a call or sell a put. It's the system of doing so. And, Matt said, hey, I haven't, I don't want to put words in your mouth, but I think you said something like you haven't seen a systematic way to do it. When you sell a call and the stock goes up through the strike price, to or through the strike price, if you go and you buy that call back for a loss on that spoke in the wheel, but then sell another call to potentially take in as much or more premium than you lost on that initial call in this spoke in the wheel. That's part of that. That's what I call a cycle of covered call trades or wheel trades. And sometimes what happens is, you own the stock, you sell a call that's somewhat out of the money. It goes to the strike. So basically you buy a debit call spread to roll up to a higher strike, maybe even a diagonal to roll up and out, which is probably more often the case. And then if it goes up through that strike again, then you do the same thing. You roll up or up and out until you get to the point where at some point the stock stops going up and it goes back down, and you've collected enough premium where that cycle, which could be selling one covered call, could be selling 2 consecutive covered calls, could be selling 3 or 4, even 5. Once that cycle is over, you have made money. So like if you look at it from an annualizing return standpoint, and I haven't really looked at these longer term ones like Matt's talking about, and that far out of the money. But if you consider it from a cycles standpoint, it's a different way of thinking about it. And if you just annualize a return on like a 2-week covered call, like that's completely ridiculously unrealistic. Realistically, maybe if you were to take that annualized return divided by like 4 or something like that. Now when you consider that it's a cycles trade, it starts to make more sense, and it starts to be a little bit more realistic. So I don't know. I guess I would be really super interested to hear what Matt says about that, and even if something like that could be back tested.
So, Mr. Dan, what you're saying is I can't sell a covered call at GameStop and then annualize that to 287%. That's not realistic. You're telling me that, sir? What are you doing to me here? Burst in my bubble. A lot of our listeners are just unsubscribing right now as we speak. They don't want to hear that noise. All right, Mr.
It's possible. It's possible.
Mr. Matt, same question for you. Obviously, the wheel inescapable these days. The wheel, 2 income components, obviously a short put and a covered call, both of which are risk equivalent. So you're kind of like you're doing the same synthetic risk trade twice. So if the covered call ain't worth doing, stands to reason maybe the short put ain't worth doing either. So what are your thoughts there? And also what Dan just brought up, his new, I guess you can call it wheel epiphany of looking at the wheel as more of a cycle type trade.
Yeah, I'm not sure how to answer both of those questions, but here's what I will say is that we have finally put the wheel back test into our quiver. So it's pretty difficult because you have to say, okay, there are 2 strategies, one triggers the other. So you have this we start with the put selling, and then so we set up a strategy around that. So what's what's a good strategy for that? Meaning DTE, how far out you want to go from how many days out you want to go, and then what's your delta around then? And then, as Dan said, what are your rules? Are you going to roll those, or are you going to do, and which we haven't put in yet, honestly. So I can't really answer Dan's question other than to say, the strategy that I like best is actually pretty aggressive. It's not what it's not what you think, and hopefully I could do this justice, but the strategy that I've fallen on, I'm putting it on in paper trading now, is the 50 delta 7-day put to sell, and then if you get assigned, you sell a 70 delta call, and that has the best risk adjusted returns, and they're actually pretty good. Pretty good risk adjusted returns, and I guess just to kind of talk about that strategy. So you're selling a very meaty put, and you're saying, yeah, go ahead and get me assigned. And then you're selling an in the money, but you're still getting a lot of premium because it's a 70 delta call, but that still means a 30 delta put. So you're getting a lot of premium, but you're not, you don't have the delta. So that's come out the best, which I think is quite surprising. So in that case, that is a strategy that I'm trying out. So I don't know if you have any questions for me on that one, but I thought that was pretty interesting.
I like that. So to translate that, listeners, for those of you who don't speak Greek, 50 delta put is obviously an at the money put. So Matt's going right to the fire, selling an at the money put And if he gets assigned, which is a pretty good chance, he's selling a 50 delta option after all, then he's coming right back after it and selling a now in the money call against it. Matt, is some of that extra meat on the bone, is that to offset the lower vol levels we're in right now? How did you arrive at those particular at the money and now in the money levels?
I mean, I didn't really have a conversation. We just tried everything, right? So we're, we kind of threw everything in there, all these different delta ranges and all these different delta ranges on the calls and the puts, and that's what came out as the best strategy for the entire period from 2007 until now. So, that's just been the best so far. So, and like I said, we haven't done what we call the kind of ancillary tests where you test things like Dan was saying, rolling up and out, trying to keep the same premium and all that. We've just, kind of tested the what we call the base case strategy, where you hold it to expiration, and then if you get assigned, then you sell the call. If you get assigned, then you start the whole thing over again.
All right, Mr. Dan, same question for you, sir. What are your thoughts on Matt's, I guess you can call it, straight to the fire wheel approach, really getting meaty with stuff? Is that how you like to set up your wheels? And any other thoughts on what Matt's putting down here?
Yeah, I find that pretty interesting. And, man, like, we've all been doing this a long time. But, I feel like the more you think about something, the more you talk about something, you can always keep learning. So what I find interesting about that, man, I wonder what your thoughts are. So, so you think about it. A covered call is synthetically a cash secured put, right? With just some nuanced differences resulting from assignment and dividends and interest and such. So I wonder, so basically what you're really doing there is selling a 50 delta put and then selling a 30 delta put, right? Because if you're selling a 70 delta call against it, that's basically selling a 30 delta put. And I wonder if some of the outperformance of that is simply from selling these higher volatilities, because even though the skew has flattened out somewhat, I'm looking at the skew of the spiders right now, and the puts are still more expensive than the calls. So I wonder if it has something to do with that, just simply selling higher volatility levels.
I mean, yeah, you're exactly right. It's like selling a put, then turning around and selling a put again. So, and that's what it's has found. It's just, that premium collection is just kind of what has turned out to be the best, for that long period of time. Again, that's a systematic strategy. That's, a way to look at it from 2007 all the way till now. Again, without doing some of the creative stuff that, with all your experience that you have, Dan, that you might do in order to squeeze the most out and have the lower amount of risks. But as far as how it performs in different volatilities and all that, we haven't tested that. But it has been a pretty interesting strategy to watch. It doesn't even do that as bad as you would think. In some of these crazy, COVID crash and the great financial crisis, it didn't do that bad. It's a very interesting strategy. And like I said, I'm paper trading it now and trying to see how it's going to do. So yeah, that's where we are with it.
I was hoping to make the definitive word on covered calls with this year's debate, but I have a feeling with all this evolving information coming out from Zero DT, we might be revisiting this in another 6 months. So let's call it the Great Covered Call Debate Part 1 here. We do have to keep going, get into our next episode of our doubleheader. But before we do that, let's go around the horn. Final thoughts for our listeners that are coming in. They're newer to options. They're struggling with these covered call things. Mr. Matt, we'll give you the final word first, sir. What do you want them to take away from this discussion in terms of should they or should they not be doing covered calls right now?
As a standalone strategy that you would just do systematically, I would say it's probably not the best idea to do. But if you have a stock that you say, hey, listen, I think it's getting overstretched, or I think I have too much, And, like a permanent portfolio might say, you want to have a certain amount invested in all your stocks. And if it's gone up and you want to sell calls against it, I think that might be a good opportunity. Or in this kind of wheel strategy, I think there are opportunities for a call selling and put selling strategy. But like Dan said, it's almost just like selling puts. So that's the way I would think of it. So on its own, probably not, but as part of a different strategy, probably yes. Or if you have a stock that you want to sell at a certain point, it's a decent strategy to do, Mark.
And Mr. Dan, the final word goes to you and the great covered call debate, at least for 2023, sir. What do you want people to take away from this?
Just keep looking at various opportunities. I mean, it has been a challenge to be doing covered calls on spiders, straight out. Even systematically, but there are still some stocks that I'm not going to stop doing them on. I think that it's still a viable strategy when we do it, in my cycles type system. And I know I just kind of, showed the tip of the iceberg there because it's only a half hour or so podcast, but I think there are still some opportunities for it right now, for sure.
All right, that is going to do it for us here on the Great Covered Call Debate 2023 edition. At least look forward to more of this. And if you're listening live, you're in the pro, look forward to another episode coming at you immediately after this one. But before we get there, Mr. Matt, if folks want to check out all the stuff you got cooking, maybe go hang out with Otto, where should they go? What should they do?
Yeah, come on over to ORATS. Check out our new back tester that has the wheel in there and 65 million other back tests. Check it out. And we got a new custom back tester where you could edit and fine tune them. So orats.com or hit me up at Matt@ORATS. And thanks for the invite to come on the show. Dan, my pleasure, man.
Oh, yeah. Always great conversation, man.
Check them out, orats.com, ORATS.com. Just don't poke the sleeping bear that is Otto. Let him lie. Just navigate around him as you're doing stuff over there. And Mr. Dan, no rogue AIs for you. What's popping off in the land of MTM, sir? We're cranking away. We've got some interesting things going on right now. We're looking at potentially doing a resolution mastermind in February down in Austin. Same thing. And we encourage you to make your way on over to markettaker.com and check us out. There you go. Check them out, markettaker.com. We got to get on out of here. Back again instantaneously. For all of our pro folks, remember theoptionsinsider.com/pro is the place to go to get access to all that fun. Back again the next week for all you on-demand folks. Another episode of Options Bootcamp. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.